Money doesn't just come from one place. It drips, trickles, flows, and floods into our lives in different ways. Welcome to Drip, Trickle, Flow, Flood, a podcast that explores the power of multiple income streams. All right, Tony, we are super excited about our guests today. So we have Gary Tice with us. He's a loan officer with Edge Home Finance. And this is such perfect timing to have Gary on because we obviously have the Fed cutting interest rates right now. And so we'll talk about how that all plays into what's going on in our world and just with folks looking to purchase homes or invest in homes right now. Gary, welcome to the show.
Hey, thank you both. I'm excited to be here. I've been doing this a very long time, 25 years. I've been with Edge, which is the largest mortgage broker in the nation since basically January of this year, and the best decision I ever made in the mortgage world. So having a lot of fun out there, helping a lot of people.
Yeah, thanks for being here, Gary. It can be such a daunting task and almost overwhelming when someone says, "Oh, I gotta try to buy a house. There's so many steps to it. How do I even get started?" And one thing that I know about you is that you are great at getting people in a position to be able to buy a house, make sure that they're ready to get a loan and all of those pieces. And maybe talk a little bit about that. What do people need to be thinking about if they want to buy a house?
Don't do what I did in my 20s, and I only owed $20 on the Bon Marché card, or dating myself, Nordstrom's, and then I wouldn't have a stamp. That was before you could pay online, and pretty soon you have a late payment. So pay everything on time, basically. That's a good start. The other one that I coach a lot of clients with is regarding the use of credit cards. So I'm just going to make up the number. If your credit line on a credit card is $900, don't have a balance of more than 30% once they print that statement. You can jack it up to $900, pay it down right away, because when that statement comes out, it's too late. It's going to hit your credit report, and they look at utilization. So a third of your score is based on how much of that credit card you're using. And if you're using over 30% or over $300 in that example, it's harmful to your credit score. And the higher the credit score, the better pricing and terms for different loan programs you can qualify or not qualify for automatically based on that.
But it's good. So you want to have a credit card or access to some sort of credit so that you're building credit. They want to see activity on that. Is that correct?
Yeah. And so some people just go, "Oh, I'm just going to throw them in the freezer, or cut them up, or what have you." And even when people pay them down, I encourage them, "Hey, you got to buy gas, you got to buy groceries. You're going to go buy things, you could rotate them." But some people just have 0 cards, or they have 1 card. Some people think a debit card classifies as a credit card, and that's not true. It has to be a legit credit card. And one thing I've learned from Colleen Jeffrey, she owns her own credit restoration company, but it's different types of credit cards have different values or points, so to speak. And so an Alaska card through Bank of America will appear to have higher credibility for a school than a lower class than that you found in the middle that been, and they'll give you a credit line of $500. It's not treated the same. It's just treat it with respect, use them. They like to see utilization. I've even seen where American Express even notices, "Oh, you've paid your card early and you pay extra." They notice it as far as on their algorithms and how they view people's credit worthiness.
Interesting. And then there's the other half, or maybe not half of the equation, but piece of the equation with income. So a lot of our listeners, Gary, are not W-2 employees. We have lots of freelancers, lots of creatives who sometimes struggle to get mortgages because they own their own businesses. So whether it's a sole proprietorship or LLC, not necessarily an S corp or something where they're paying themselves as a W-2 employee. So Do you have any tips or insights for that crew of folks who are wanting to get a mortgage?
Cash is king. And a lot of people, especially first time home buyers, whether you're self employed or W 2, it doesn't matter. Cash will provide you options as far as different loan programs and how much you can qualify for a home, for your dream home, perhaps. And here's one that self employed people do. They'll get a car, but they pay for the expense themselves versus having the business pay for the car. If I can show 12 months of cash checks or a paper trail that the business paid the vehicle loan directly, then I don't have to count that payment, and it'll help qualify that borrower for a higher balance loan that they can qualify for. Just one quick back, we were just talking about credit cards. A lot of people just have maybe one card or two cards. Ideally, Fannie Mae and Freddie Mac, they like to have 4 trade lines, which means it could be car payment. It could be 3 credit cards. That's okay. People go, should I get another credit card? Hell yes. Get 2 more or whatever, so you can create multiple trade lines. It really can help dramatically in qualifying for a mortgage. But for the self-employed people, a lot of self-employed people are good at business. They suck at bookkeeping. Hire someone to help you navigate that. And so you can keep your books in order, and it'll make the tax season a lot easier. Also, a lot of people, they want to write everything off when you're self-employed. I get it. You don't want to pay Uncle Sam or as little as possible, but that can hamper you sometimes in qualifying. So sometimes going the traditional route using 2 years tax returns won't work for the typical self-employed person. So the good news is there's options out there for those people. There's profit and loss loans. There's bank statement loans where we'll just analyze the last 12 or 24 months of bank statements and they'll generate income out of that. And usually they can qualify for a loan versus they wouldn't be able to qualify because they write too many things off on a traditional Fannie Mae, Freddie Mac loan.
Let me just step in here a second. So the reason that's a problem that they're writing so much off, because obviously everybody said write off, everybody's told by their accountant, write off everything you can so you pay fewer taxes. But by writing everything off, it just shows that your income is lower.
Correct.
Okay, someone walks in the door and they say, I want to get a loan. I want to buy a $500,000 house. Let's talk. What do people need? They need a down payment. They need their tax returns. Maybe they need some pays. What's everything people need together when they are going to show up to you so you can give them their mortgage?
Traditionally, I'll get a picture of a driver's license, last 30 days pay stubs, last 60 days bank statements, last 2 years W-2s. If they're self-employed, I'll take the last 2 years personal and business tax returns as well. Maybe they don't have any money at the time, but I'll ask, or they have very little. Hey, do you have a co-signer? Do you have someone who can gift you some money? I'll at least plant the seeds, because many times the answer is no up front, but as they'll get more creative as they find out, oh, I lost out on a house. I need to buy a more expensive house for my needs than what's out there. Yeah. So those are the traditional pieces of documentation that we'll select.
So how do underwriters, and so underwriter, you could explain this, Gary. Underwriter is the person that's actually going to be ultimately approving whether the loan happens or not. But how do they look at multiple income streams? Drip, trickle, flow, flood is all about having different income streams. And how is an underwriter going to look at that to see that income's coming in a variety of different ways?
They don't mind that at all. Not a big deal, whether it's a conforming Fannie or Freddie or FHA or VA, jumbo loan. There just has to be a consistent track record. Typically, when you're self-employed and you have multiple streams of revenue because you've created it yourself versus, say, a pension or Social Security. They're going to want 2 consecutive years of proof of that income has flown into your accounts. Now, we have programs where, hey, I've only had it for 12 months. The good news is we can get you a loan through bank statements or profit and loss type things. But they just analyze this. They look at depreciation. We add back in depreciation. So that can help basically generate additional income for people who write things off. It just depends on what they're writing off on their returns.
So if someone has a W-2 and then they had some sort of side hustle or some other sort of income stream coming in, they'll add that into the equation?
Correct. Now, recently, Fannie Mae, Freddie Mac have made some changes. Maybe it's for the better, maybe it's not, because it takes several jobs anymore to survive, but with the gig route, right? But they want Fannie Mae, Freddie Mac want you to have 2 consecutive years holding, let's say you have your side gig, you've had that for 2 consecutive years or more, and you've had your W-2 job for 2 consecutive years or more. They'll count both of those. But if you had your side gig and you just started a new job, I can't count both incomes
Interesting.
on a conforming Fannie Mae, Freddie Mac loan.
So how you've been doing this, obviously you went through um, all these different time periods of loans. You were doing it in 2008. How is it to get a loan these days?
It's easy. I think so. Yeah, I've been doing this since 1999, so I've seen lots of cycles. And Fannie Mae and Freddie Mac, they tighten up, they loosen up. But I think overall, it's better than during '08. This didn't happen at any institution I worked at, but it was a local institution where I was told the person, they were making $200,000 a year and they had to source and document every $50 deposit that went into his account, which is ridiculous, right? So I think underwriting is a lot easier. It's, they're pretty flexible as far as trying to help borrowers obtain homeownership. They want to approve loans. We're not in the business of turning down people. So it's nothing to be scared about. I help people all the time. Hey, you can't qualify for this now, but you need to do this and this. And some people are good listeners. Some people aren't. And sometimes they'll come back to me a year later. Oh, have you done this or that? No, we're still in the same holding pattern then. It's hard to break habits, but
So, I
there's a
mean, it
lot of
sounds like
creative.
you're working with people for a long time. What kind of is this something where you're working with one person to get a loan for a year or two and you give them a loan and you never talk to them again? Or is this something where someone buys a house, their first time house, you help them out, and then they come back to you a few years later, they've got kids now, they want to move. Are they coming back to you again? Is it are you giving the loan, helping people get mortgages multiple times in their life?
Absolutely. I just helped a young family. They're moving to Texas. I helped him finance a house about 8 years ago, which was his first time house. Now he's married. He has a baby. He's got a job in Texas. I helped him finance a house down there. Everybody, sometimes they just stay in the same house and they keep the same loan and they don't ever refinance. Or some people say, hey, I've got a great rate and I'll never refinance. But sometimes down the road, I need to take cash out now because I need to send Sally to school or buy a second home, buy a car, what have you. And so it's, it's all over the board. It's all over the board. Work with a lot of first time home buyers, a lot of people in the $1 million range. It's soup to nuts. And as people progress, I've seen through the cycles there for a while back in Washington Mutual days, we were refinancing a lot of people in the 30-year fixed, and then the market changed and people were then condensing things into a 15-year cycle. And so we did a lot of 15-year terms because pricing was so amazing. But then we've had to refinance a few people out of that too, because things got too tight. So sometimes I don't recommend pay on it like it's a 15, but get a 30.
Oh, so that's interesting. And I've talked to a lot of people about different loans and what type of loan to get. And I think a lot of people don't necessarily know this, right? So maybe explain that a little bit more. If someone gets a 30-year loan, it gives them the flexibility that they can make that payment based off a 30-year amortization. So it'll be paid off in 30 years. And so your interest and principal payments are based off of that. If you pay more on that 30-year loan, that additional payment goes towards principal. So you're paying that off, but then the next month, if you don't have the extra money, you don't have to do that. Versus on a 15-year mortgage, you're paying it off in 15 years and that payment's going to be higher.
Yeah, I encourage people, don't paint yourself into a corner. Another way to reduce your mortgage balance is if, again, I'll make the number up. If your principal and interest is $1,200, if you divide that by 12 and just add another $100 automatically every month to your mortgage payment systematically from day one, you'll reduce the back end of your mortgage from a 30-year down to like a 25, 26 period loan. And there's no fee to do that. You're just adding money every month to principal. And so that's an easy way to help shrink that balance. The 15-year, does it have a 6-year rate? Yeah, it's probably a half point to 3/4 of a point lower in rate in comparison to a 30-year, but you're reducing that amortization by half. And so that payment really jumps and life jumps out in front of you. And then you have to make a new decision because maybe your spouse lost their job. Now, maybe you have 4 kids and you need to feed them or you buy a car. So I really play devil's advocate with people that just pay extra on the mortgage. Like it's a 15-year, we'll figure out whatever the 15-year payment is. So you feel good about that. And that way you provide yourself parachute should things turn sideways.
Okay, it seems like we've mainly been talking about someone who's going to be buying a house they're going to live in. What about investment properties? What's that world look like if someone wants to buy a rental house? What are we looking at down payments versus a primary or a rental house investment property? And then what are interest rates? What's kind of the difference going to be there?
Like for a primary, you can go as little as 0 or 3%, 5%, or on as far as if it's your primary residence. Rental properties are a little bit different. Lenders, investors, they want the borrower to have a little bit more meat in the game. And it's going to take, for example, on a single family dwelling, you can put as little as 15% down. If it's going to be a rental property, you'll have what's called mortgage insurance or private mortgage insurance or PMI, but that'll eventually go away. But what's been very popular these days, especially with self-employed people, are what's called DSCR loans, debt service coverage ratio. And basically, there's no tax returns involved. They look at your credit score and the income from the property. So if the income from the property is $4,000, they just ideally don't want your principal and interest, taxes, and insurance, or your PMI or PITI to be over $4,000. Boom, and you qualify. Generally takes 20 to 25% down to qualify for that. But that's no different than a traditional Fannie Mae or Freddie Mac on a multi-unit, say 2 to 4 unit. They want you to have 25% down. Might be able to do it with 20. But the rates, I haven't looked lately, but last week I was looking around and I've seen rates in the 6s on those.
On investment
So,
properties.
on investment properties. And overall pricing has been improving. We talked about the Fed reducing rates. the Fed, most people think, oh, that's a good thing. They really control interest rates. It's really, they don't. The world bond market controls, they're the tail that wags the dog, basically. And when the Fed lowers rates, they lower short-term interest rates, credit cards, HELOCs, car loans. It's based on like a 1-year treasury note. Mortgages are based on a 10-year mortgage-backed security. So it's really, they're both fruits, just one's an apple, one's an orange.
Yeah. Okay. Expand on that a little bit because everybody, like the Fed just announced that they're cutting 0.25% off the rate. And so I'm assuming everybody's okay, great. Going to be time to refinance. Now's the time to buy. Maybe they're waiting out because the Fed's going to supposedly cut, they might cut a little bit more here in the future. And we don't need to get in the weeds in this. The Fed's job is they want unemployment low and they want inflation low. And those things don't always play hand in hand. And so that's what they're trying to balance. And their biggest lever to pull is interest rates. And so that's what they're trying to do. And as unemployment has ticked up just a little bit, still historically fairly low, but it's ticked up a little bit. So they've lowered this 0.25%. But that doesn't necessarily impact home loan rates. That's not going to necessarily impact mortgage rates. Yeah, explain that a little bit more of why the bond market controls that and how kind of bond rates work.
Here's the simplistic aspect of it is basically the world bond market, money's going to go best where it's treated the most favorable with respect. And that's anywhere around the world. Basically, the world bond market feels that we as a government owe too much money in general. We don't have control of our house as far as we spend too much money versus what we take in. And so
We as in the United States?
We as in the United States.
Yeah.
And if someone's considered a higher risk, if someone has $1 million in the bank and they want to borrow 10 grand, they're a pretty good risk to loan them 10 grand. If they're negative $1 million in the bank, they're a much higher risk. And so we fall in that negative $1 million in the bank. We're a higher risk. And so people aren't as warm and fuzzy about wanting to place money in our markets as they've been in the past. And here's what happened, not this most recent time, the last 2 consecutive times the Fed lowered rates by total of 50 basis points, or meaning a 1/4 point each time. So a quarter and a quarter is a half. Mortgage rates popped up by a 1/2 point as well. They went the opposite of what traditionally has happened in the past. Now, the most recent time, just here recently, this month, the Fed lowered it, and I had no idea which way it was going to go. But overall, the trend has been your friend, and rates have been improving. Pricing's been improving dramatically. In fact, rates are about the lowest they've been in 12 months, about here, give or take a little bit. And so it should be opening up some avenues for people to qualify for a higher mortgage with the more favorable rates. But yeah, it's just, we owe too much money. And so we're not quite the ironclad golden solid risk that we used to be as far as the United States goes.
Yeah. So since the US has a lot of national debt, people that are buying our bonds are going to want a higher rate than they would if we were maybe a less risky investment. And so that's driving bond rates up, which is in turn driving mortgage rates up. Is that a good summary?
Yep, that's a good summary. Off balance sheet debt, meaning Social Security, Medicaid, Medicare, probably a few other things in there, I think is $30 trillion that we don't really count. But the rest of the world does. And along with that, when they want their gold back and it takes us 12 months or longer to ship it back to them, it creates an untrustworthy feeling, so to speak, in the marketplace.
So there's a lot of geopolitical stuff that's at play with the bond market, it sounds.
Absolutely. And that's with any country.
Yeah.
Years ago, it was Greece that was always in the Wall Street Journal or what have you. And rates jumped a lot. Their dollar sank, or their whatever they use for currency there just evaporated.
Yeah, I remember that was when I didn't go, but that was when you were supposed to travel to Greece. It was going to be super cheap.
Uh-huh. Yeah, we should have both gone.
Yeah. Gary, this has been great. What else should, someone be thinking about if they're preparing to buy their first house, preparing to move from one house to the other, or if they're looking to get into real estate investing?
A couple different things. When people are shopping around for rates, for example, something that was just passed September of this year was the home buyer privacy protection, where basically they fill out a form online and they're not going to receive, when they go to apply for a loan, maybe people apply for a loan at multiple places, which is not necessary. But basically, it's going to stop the annoying phone calls. When I pull someone's credit, sometimes I'll warn them, hey, you're going to get about 100 phone calls. And it's quite upsetting and quite annoying. Shop around. Being a broker, a mortgage broker, national stats show that we save the typical home buyer versus if it's a credit union or bank, it doesn't matter. We save them over 10 grand almost every time, or on average. And we see it all the time in the office. One of my coworkers was prep something for a borrower, and the borrower just couldn't believe it. We saved them $11,000 on the same transaction that they were shopped a credit union and 2 or 3 different lenders here in town. Shop around.
Is that over the course? That's over the course of the loan?
Actually, that was just upfront fee.
That's just the loan origination.
That was just in closing costs. We saved that borrower $11,000. Here's what's really common these days are people, I don't want to sell my house because I can't find anything that I want. Oh, but I need the equity from the property to buy the house, but I don't want to list it because there's nothing. It's the chicken or the egg thing. And so bridge loans out there, we do a ton of these, and there's a ton of different types of bridge loans out there. One that I like out there is you can take equity out of your existing house, of your future departing house, typically up to 75, sometimes up to 85% of its value. Use that for the down payment for your future home. And there's no payment on your departing residence for up to 12 months. So that buys a lot of stress-free calmness for the person selling it, because you just don't know how long it's going to take to sell your place. And there's most of them out there are 3 or 4 months. You got to hurry up, sell your house. I've seen that with people, and it's a pressure cooker, and time goes by really fast. And bridge loans are huge these days as far as talking about them, getting used to getting people familiar with the terms, educating realtors on how it works. And it's really a breath of fresh air as far as letting people have the opportunity. So they only have to move once, basically. Yeah, everything's negotiable. Call around for rates, talk to different agents, call different homeowners insurance folks. Home inspections are really important as well. Years ago, where I work, he bought a brand new house from a very reputable builder in town. And at the time, the home inspection was $300, and I thought he was nuts. Wow, you just threw away $300, you idiot. Come to find out, hey, they didn't do this right, they didn't do that right. There's a few things on there that they made him go back and fix. And so The home inspection is very important. Now, maybe depending on if you're in a competitive situation, you're not going to have that opportunity. But if you can at all, it's well worth the expense. Probably save you a lot of time too, as far as buyer's remorse. Oh, I didn't know about that dry rot or the water underneath here over there. But one other thing is, it reminds me of Tim, the tool guy back in the day, the Vinford 2000, right? Where the dishwasher pretty much melts everything in it. 75% of the people, this might be changing a little bit with people hanging on to those 2 and 3% rates, but 75% of the population moves every 7 years. So why would you want to pay for something that you're never going to take advantage of, meaning a 30-year fix? Because depending on the interest rate cycle, many times ARMs can have better terms, meaning a lower rate, which equals a lower payment.
So an ARM, just if people don't know, an ARM is a adjustable rate mortgage.
Correct. Yes. And so they'll be fixed for a period of time, typically 3 years, 5 years, 7 years, or 10 years, amortized over 30, just like a 30-year fixed, because the term is fixed for a shorter period of time. They basically, in not all markets, it's becoming more favorable for ARMs right now, that you can save 1 to 2 points sometimes in rate, which is a big chunk of savings versus a 30-year fix. A lot of times I coach people on a refi. Hey, pretend then you were making your 30-year fixed mortgage payment on this ARM, and you're going to crush your balance that you owe even faster.
Yeah, no, those are good tips. And I think, some pretty exciting news for the audience. I think I saw that they're doing a home improvement reboot. So we all have that to look for. We're going to have Tim and Al back on the screen.
Nice. That would be fun.
I don't know if Justin Taylor, what was it? JTT, right? Was that Justin Taylor Thomas? Wasn't that his name?
Jonathan.
Jonathan Taylor Thomas. Yeah. Yeah. Melissa knows. She is probably a big heartthrob for Melissa.
No. I just work in that industry, so I don't know the actor names.
Yeah, I love that show.
That was a good show. Thank you, Gary. This was super helpful. I was taking copious notes myself, so we appreciate you being on. I also appreciate your demeanor around this, because we have a lot of listeners who are first-time home buyers, or who maybe owned a home in the past and are in a different position now and trying to purchase something. And I think there is a lot of stigma out there, feeling not as confident, or maybe having not the greatest experience when having a conversation with the broker. And I feel like you broke down everything so well.
Well, thank you.
Just had a really great, comforting demeanor about yourself. So contact Gary, everybody listening, if you are looking for Lou. And with that said, we so appreciate you being on. If you enjoyed this episode of Drip, Trickle, Flow, Flood, please rate and review on your favorite podcast platform. We're also on YouTube now, so if you prefer to listen there, please do. And we will see you next time on the next episode. Thanks, everybody.
Thank you.